From Asia-Pacific's storage revolution to Europe's transition challenges, our latest long-term power market outlooks explore how regional developments shape the global energy landscape. I've been tracking Asia-Pacific markets for over a decade, and what we're seeing now is truly unprecedented. We're looking at $3.9 trillion of investment over the next decade. That's 44% more than we saw in the last. Solar is leading the charge, taking a third of total investment. But here's what's really exciting. Energy storage has gone mainstream, capturing 14% of investments through to 2034, more than gas or coal power. We're not just building more capacity, we're learning to manage the boom in intermittent renewables and building the power system of the future. The Asia-Pacific region has been driving over 80% of global power demand growth, and rapid electrification continues. Strong power demand growth averaging 5% annually shows no signs of slowing, despite many global uncertainties. What is remarkable is that we've hit a turning point this year. Power sector carbon emissions have peaked in Asia at 8.2 billion tons of carbon dioxide, as renewables start to push out coal power. By 2030, I expect renewables to jump to 40% of power generation from 27% today, whilst coal drops from 53% to just 38%. Energy storage revenues will explode from US $14 billion today to $184 billion by 2035. This isn't just an Asian story, but the region is setting the global pace.
What strikes me about North American markets is how we're seeing real demand growth for the first time in 20 years. We expect demand to grow at 2% annually through 2050, up from our previous 1.6% forecast. Data centers and manufacturing are driving this surge, and we're seeing data center developers paying staggering amounts of money to secure power supply and infrastructure. But policy uncertainty is a major challenge. Tariffs could raise costs across all generation technologies, and the One Big Beautiful Bill promises to reorder the power market for years to come. Meanwhile, turbine manufacturers tell us they're sold out for years ahead, presenting a challenge to meeting demand growth. Despite this, we see the existing gas fleet rising to the occasion and a robust story for gas demand. The result? Natural gas prices rise to nearly $7 per MMBTU by 2050, and power prices are bullish. Clean energy still reaches 72% by 2050 in our view, though policy headwinds are slowing the pace. North America's industrial renaissance is reshaping global energy demand in ways we're still understanding.
Europe's story is becoming more complex by the month. Global trade tensions are dampening growth and confidence, creating headwinds for the remainder of 2025 and beyond. Political commitment to Europe's decarbonisation remains, but delivery is where challenges are mounting. Permitting and green hurdles continue to make it difficult to translate policy ambitions into market reality. In Spain, high solar penetration has driven curtailment and grid stability issues, as the Iberian blackout in April so painfully demonstrated. Offshore wind faces a rising economic test, and we've seen an 18% downgrade to our outlook. However, renewables still reach 65% of supply by 2030. But stability depends on flexibility in the form of supply, demand, storage, and infrastructure. Demand growth will be weaker than many expected. Electrification in transport, heating, hydrogen has lacked momentum with pushback against the 2035 ICE ban and 2 years of failing heat pumps sales. Despite these headwinds, decarbonization will persist at a more measured pace, as Europe balances its ambitions with the practical and economic realities of delivery.
Chile perfectly illustrates how regional markets can drive global commodity transition. Despite a 5% demand decline in 2025, long-term growth averages 3% annually through 2050. Green hydrogen and electrical vehicles are fueling this transformation. New loads will represent 27% of total demand by 2050, with Antofagasta emerging as the primary hub for both mining and hydrogen projects. What is fascinating is how decarbonization drives unprecedented renewable expansion, creating 16% oversupply by 2035. Renewables will reach 83% of generation by 2045. supported by 25 gigawatts of storage capacity. The entire coal fleet disappears by 2035. That's a complete transformation. This renewable surge reshapes power economics dramatically. Marginal costs will drop 64% from $53 per megawatt hour in 2025 to $19 per megawatt hour by 2040. Battery storage initially provides lucrative arbitrage opportunities, averaging $79 per megawatt hour. Chile's transformation demonstrates how regional decarbonization can create global green commodity supply chains. We are watching local energy transitions connect to worldwide industrial demand in real time. So, to conclude, these regional stories don't exist in isolation. They connect across global supply chains, commodity flows, and technology deployment.